Good morning, everybody, and thank you for joining us for today's event on digital asset custody. Looking like a really fascinating lineup ahead. We're going to kick things off with Raimundo Castillo, who's the CEO of Prosegur Crypto. He's going to give us a brief presentation on what Prosegur are doing in the space, and then he and I are going to have a brief conversation about it, and then we're going to move on to a panel which my colleague Frank Chaparro will be steering. But without any further ado, now I'm going to hand over to Raimundo, who'll kick things off with a few slides.
Thank you, Ryan. Thank you for this invitation. It's a pleasure being here with you in such an interesting webinar today. Yes, my name is Raimundo Castillo. I'm CEO of Prosegur Crypto, and Prosegur Crypto is the new service of the Prosegur Group of digital assets custody. We act as a third-party custodian for institutions, and we have been working very hard the last year to launch this brand new service. What we think is a unique solution for the institutional market. Let me start by, for those that don't know Prosegur, give you some figures about the Prosegur Group. The Prosegur Group is a global leader in the security industry and one of the most trusted partners for leading financial institutions for cash management and custody services. We are operating in 26 countries across 5 continents. We are ranked number 2 globally and number 1 in Latin America. We have 160,000 employees, and we have 400 billion euros under management with annual revenues of 3.4 billions. We have also more than 500 vaults globally, and the most important thing is we serve more than 200 banks, 200 of the most leading banks all over the world, and we also collaborate with central banks in the custody process with these banks in each country where we operate. As said, we have been working for launching recently this custody service, and in this journey we have collaborated very intensively with our technology partner, which is GK8. GK8 has been very important for us as their technology fits very much the security level that we were looking for building this solution. What we have done together with GK8 is combine the cutting-edge cybersecurity technology that GK8 has, that is really the safest technology that we know, with our physical security capabilities in a unique and comprehensive custody solution for digital assets in what we call the crypto bunker. This is an ultra secure space, and what we think it is the safest space where digital assets can be kept, integrating both capabilities in a 100 cold and unreachable environment. This is the security part of our solution, and I think we have reached together new level of security for digital assets.
Thanks very much, Raimundo. I'm going to try and rattle off a few questions now in the time that we have before the larger panel. So It's you hear about it often. It's a big decision for any large institution to sort of take the leap into the cryptocurrency space, and particularly for an organization of Prosegur's size. Tell us a bit about how you sort of managed to convince yourselves to take that leap.
Yes, absolutely. It has been a really challenging step, but very exciting step at the same time. I think there are two elements that help us to take the decision. First is it is the purpose of Prosegur. Now, the general purpose of Prosegur is making the world a safer place for individuals, companies, and the society in general. And as security is really a an urgent need for institutions. This has been a natural step in the company. The second element I will highlight is the innovation, right? Prosegur is a very innovation-oriented company. We are constantly looking for adding value to our customers with technologies, new solutions, and in one of our several innovation events, let's say, the possibility came to on the table to enter the crypto space, and I think the company immediately bet for this. So I think these two elements has helped us to take this step.
An innovation-oriented company, but certainly a more traditional financial institution. What do you feel that I suppose more of an old school company like Prosegur can bring to this space?
Yes, I think we have more than 40 years experience in understanding risks, managing risk, and minimizing risk. So I think this big experience is a big asset for entering this market. No, we have analyzed very deeply the risk in the whole custody chain. We have identified more than 100 risk points, and definitely we have categorized two big areas. One are the cyber risks, and the other the physical. The cyber risks are totally covered with our partner that is GK8. They have a best-in-class solution that we have integrated in our solution. And physical risks are risks that are under our vision really underestimated and hardly covered in the market. And we are seeing that new custody players are getting aware of the importance and of the complexity of handling these kind of risks. I think this is the physical security is the missing part of really best-in-class solution, and I think we have proved that with our experience and with our partnership with GK8.
And once you decided to enter the market, I imagine you conducted a fairly extensive sort of scan of what was out there in terms of prospective partners and existing solutions. What exactly were you looking for before entering the space?
Yes, we have analyzed the different models, cloud models, hot wallets, everything what's on the market in custody security, and definitely we have seen that the safest model is the cold storage. Other security models are safe; they are getting safer day by day. But in the end, the cold storage is the only model that is really unreachable. And unreachability is a concept that we work a lot in Prosegur. It's the inaccessibility to get into our facilities, into our infrastructures where we have all the cash of our clients. And this concept, GK8 works this concept very well. They have a really unreachable solution, 100% offline solution, patented solution by them. And yeah, we were looking to a cold solution that was able to combine with our physical security. That I think it is the missing part of a set best-in-class solution.
Well, I'm sure we'll get more into the merits of hot and cold storage later on in the panel with Frank. But for now, maybe you could just briefly clarify what each of you bring to the sort of combined solution that you've come up with. You know, what is Prosegur adding, and then what on the technology side is GK8 bringing?
Yes, I said the security part of our service is this crypto bunker. This is really something unique, where we have combined two different cold spaces. No, let's say the cold storage of GK8, which is something unreachable, with a cold space for the storage of the system, a safe place for the storage of the system, and a safe place for the teams that are handling the system, which is something very, very important. As a cold solution, some manual operations are required, and the people managing these manual operations, they have to be in a secure space. And we offer in this crypto bunker the space for the storage, the space for the teams to handle safely the solution. These both things are our security part.
Okay, and you've entered the crypto market with a custody and security solution. I wonder if you see that as the foundation for launching further services in the crypto market going forwards.
Absolutely. Custody is much more than only safekeeping keys. It's about giving a whole service for institutions that really want to trust on a third-party company to make this custody. And there we are speaking not only of the security, which is the main part, but also about the access, an easy access for them to manage their assets, right? And in this sense, we have built also a really very accessible technology platform for the use, not only for the management, but also for let's say the access for their own customers. So it's really a very important part that we also offer in our service. And there are other things like DeFi services that we are working on, like staking, or other options or service options like insurance that we are also including in our whole service. It's as said, more than security. Security is the main part, but at the end, it's about having a service that is totally trustworthy for the institutional market.
And how far away do you think those products are, the DeFi and staking and so on and so forth?
In a couple of months, we will have everything in place.
Okay. All right, Raimundo. Well, thanks very much. It was short and sweet, but we're going to move on to the panel now, and I think Frank is going to take over. But it's great to chat.
Thank you, Ryan. A pleasure.
That was great. Thanks, Ryan. Interesting segue to the conversation today. Hello, folks, ladies and gentlemen. I'm Frank Chaparro, Director of News at The Block, and today we have 4 panelists joining me for a conversation about how banks can prepare for digital transformation. We have from Goldman Sachs, Oliver Harris, Vice President at the firm, Benjamin Duvet, Head of Digital Assets and Custody at Commerzbank, Dean Demelweek, Digital Transformation Leader and Blockchain evangelist at BNP Paribas, and Lior Lamesh, CEO and co-founder of GK8. Ben, we were joking before we turned on the cameras about my most recent appearance at Fox on Fox Business. I made the joke, I was talking to the host that, 6 months ago, maybe a year ago, I could barely get a bank to return my phone calls. Now they're doing webinars and panels with me about digital assets and crypto. A lot has changed over the past 6 months, though. Bitcoin's at $60,000. You see a red hot market where big firms like PayPal and others have and are continuing to look to snap up scrappy crypto firms. When we look over the past year or 6 months, what changed the paradigm for banks? Is it simply the price of Bitcoin? Did the lawyers and regulators get off your back? What's different now? We'll start with you, Ben.
I would say it's straightforward, right? Client demand, and people were buying Bitcoin. And then it's always up to the regulators and to the established industry who helps you access value to do it in a maybe more safer, easier, more regulated manner. And in Germany, I have to say, we have a very forward-looking regulator who would allow us now, and that's what a lot of German banks are looking into, to apply for a crypto safekeeping license. So the same regulator who gives me my bank charter would allow me, if I go and present to him a proper, reasonable business case with all the safeguards and everything, and would allow me to safekeep crypto assets, including Bitcoin, on behalf of my clients. So I think that it's a twofold topic. I think people were investing into the assets, and the regulators and the banks understood maybe it's better to protect the average investor by putting some rules and rails around it, which make it safer and more accessible. And at the same time, regulation moved to allow banks to step into that fold, but also other firms. So in Germany, which I can always talk to a lot, it's if you were a crypto safekeeping place and you had certain safeguards and rules in place, you could grandfather your old custody solution and had to apply last fall for the new regulation. That means there are firms out there who, with regulatory approval, it's temporary because you have a grandfathering rule, offer crypto custody in a regulated and thus probably safer manner than some of the providers you choose somewhere far away in a jurisdiction where you will never have access if something goes wrong around your funds.
Understood. Oliver, your firm, Goldman Sachs, has made many headlines tied to Bitcoin, cryptocurrency, digital asset. If you rewind the clock to this past summer, similar story unfolded, right? There was talk of potentially a Goldman Sachs coin, tokenization of everything. Now things seem to be a bit more focused on Bitcoin, opening up Bitcoin to, or at least Bitcoin related products to private wealth management clients. What changed? To Ben's point, was it simply, clients cared more about Bitcoin than they did tokenization of assets? What was the story there?
Yeah, sure. I think to Benjamin's point, certainly client demand is a key factor, and is certainly correlated to the price of Bitcoin. But I would say more broadly, the crypto bull run we're currently in at present. And I would say from our perspective, we've always been taking a broad approach to digital assets, both on like the enterprise blockchain side as well as the cryptocurrency side, and again, just responding to client demand. And at least from our perspective, since our investment in BitGo back in 2018, have been following the space extremely closely.
And so Goldman, like many other banks in financial services, have issued requests for information to learn more about custody, to explore sub-custody. It seems like at this point, most banks aren't looking to go it alone. Why is that?
Yeah, that's right. I think there's a broad range of options, obviously, not just banks, but financial services more broadly, like looking at the acquisition route, whether you're PayPal with Curve, the partner-led models like Bank of New York Mellon investing in Fireblocks and then partnering with them. And I do think more broadly, you are going to see, banks taking like a nuanced view and thinking through different models. And I think partnership through, sub-custody is definitely going to be one of the key, operating models for many banks.
Lior, we were talking a few days ago about the pros and cons of self-managed custodial solutions and then sort of crypto custody as a service, right? So break down for the listeners exactly maybe where you guys fit into the ecosystem and why folks should maybe be paying more attention to GK8 versus a firm that may be viewed as more traditional, like a BitGo or BNY Mellon.
Sure, Frank. First of all, very honored to be here today. So eventually, we don't see a chance that banks will develop by themselves the infrastructure, right? There is a lack of knowledge internally, and it's not effective for them to develop the support by themselves. So there's mainly two options. The first one is to have the infrastructure in place, partnering with self-managed solutions, such as GK8. And the second option would be using a third-party custody as a service. Now, using third-party custody, it's great because it's something that you can do in order to start quickly. And there is somebody else who is taking care for the operation and taking the responsibility. But on the other hand, when you have your own self-managed solution, then the bank can actually control its own assets, right? Our bank are making money. They're making money out of money. And once they have the money for them, they have mainly the flexibility and the availability. So they can execute different strategies, different applications, different services on top of their self-managed solutions, as well as the availability to make an immediate withdrawal rather than relying on somebody else that the SLA may take too long. Now, when it comes to the security perspective, eventually, if you decide, there are two main solutions, right? You can use either hot wallets or cold wallets. When it comes to hot wallets, we all hear about the MPC, which people think of as the standard in the market. And on the other end, you can have the cold vault. Now, it should be understood that MPC by itself should not be sufficient for bank, because MPC eventually is the ability to take the private key and split it into multiple parts, like 2 or 3 different parts that hosted on 2 or 3 different internet-connected computer. And the idea is that hacker can invest a few $1 million. Based on our experience, it would be an average of $1 million per internet-connected computer in order to take control on the full MPC environment and then steal the assets. So MPC is great for the high-frequency automatic transaction, but by itself is not sufficient. While on the other end, you should have a cold wallet in place. But the problem with the existing cold wallets is that they are not really cold, because there is some point where they need to receive input from the internet. And what we do, by the way, in GK8 is that we have the ability to make the full process of creating, signing, and sending blockchain transactions without the need for receiving any input from the internet at any point. So taking that to manage the majority of the assets, along with the MPC to manage small amount of assets for high-frequency transaction, should tackle this problem.
It's interesting. We can get a temperature check from the folks at the actual banks. Dean, we can go to you for a second. What do you think? Why aren't banks going it alone and building their own tech stack out?
I think when we mentioned actually this custody challenge, I think this is the key part of the new financial market infrastructure, how I see it. And I think we need to be very, I would say, strategic when we talk about the custody side. What Leo actually mentioned as well, I agree with his views on combination of cold and hot solution. I think the question which remains is how to strike balance between scalability and security, when I mention scalability, I think we are talking about several thousand transactions per second. Can this solution allow us to have this kind of transaction?
Scalability is a huge issue across the entire crypto market.
Yes.
Ben, we were talking a few weeks ago in preparation for the call about how a lot of what's being done in crypto custody kind of can serve a foundation for the digitization and the tokenization of many different assets. Is that what's happening? Is it sort of, we're going to build out this crypto custody, but then it can sort of function across many different assets?
Absolutely. So this is actually, when we talk about digital assets, so we are talking about cryptocurrencies, we are talking about stable coins, CBDCs, and obviously the most important thing is about native digital securities. And this is why I think one aspect that we need to look at is how the investors, let's say, can manage the various assets in their portfolio, which are digital assets, physical assets in one portfolio. So my personal view is that actually we are going to see probably one-stop shop, and this is what I see at the moment with those digital native banks. So they're trying to develop the solution, which sounds like one-stop shop actually. So they want to address various assets across various verticals. And I think this is the challenge, because the investors actually will have in their portfolio different assets, definitely. And how I see, if I may just add something else in our conversation, I see that there's three critical, I would say, responsibilities for digital assets custodians, like safekeeping, connectivity, and compliance. So when I mentioned connectivity, I think this is another thing that we need to look at, how we are going to abstract away the complexity of the underlying blockchains, DLC, and to allow actually for one layer, to create one layer which will enable connectivity with different players, like dealer brokers, prime brokerage, so on. And I see that as well as it's challenging, but as I said, this is I see this as a part of the distributed markets infrastructure that we are going to build in the next 20 years.
Maybe to add to that, I think the component which is important. I think the component to keep in mind is for a bank to operationalize something. That's a true challenge. So we have a mature assets already in the market. We, as Oli pointed out, we have a client demand. So Bitcoin and some of the other cryptocurrencies could serve as the most mature current assets you operationalize within a bank. The tech stack you need, and I think the discussion, I think we talked to Lior already a year back, evolved from there. If you talk to any provider who came to you with a storage solution a year and a half ago, they offered you a hot cold storage for Bitcoin and then some other digital assets. Now they all have that as part of a suite and overall solution to serve your multi-asset digital asset platform. So going from tokenization to everything, but you have to start somewhere. You need a business case, but you also need people to tick boxes and check, does this work in the current operational system of the bank? So why not choose an asset which is mature, where there's client demand and which already works, like Bitcoin, Ether, implement it in the bank, but choose providers who are able to give you the full suite of digital asset. And Dean mentioned it, I'm a custody guy. For me, it's usually very normal. I connect to many different CSDs or sub-custodians in different countries with different rules, with different connectivity, all of those topics. So a multi-asset approach in digital asset really mimics what they do today. What I hope, though, is standardization, an easier tech stack. And I think the one thing why the technology is so interesting for me, and I think for banks, is we have a decade-old capital market system, and we have the ability with the new technology, which is very promising, to rethink all these different components, all these different layers we have put in. And it's a little bit like starting anew. So I go to my tech guy and said, hey, how about we build a digital asset world in parallel to the old world? I'm not supposed to say old world. I think the PR people always tell me that's not the word to use, but that's actually the truth, right? The new world and the old world, and you grow the new digital assets universe while the old universe becomes less and less relevant because you issue your new bond as a digital asset, not the traditional way anymore. Legally, it's the same, but from a technology point of view, it's different. And that's how you then build the new bank without starting in a green field. And I think that's very important for banks. So start, operationalize something, start somewhere, but go with partners who can later on roll out the full suite you need for a multi-asset platform. I think that's very important.
Yeah, I'll just add that if you're, it really depends on the type of assets. Like if you're looking at tokenized assets and storing keys on permission blockchains versus like Bitcoin and ETH, that, you know, we are still getting, I would say, acclimatized to some of the unique considerations around like bearer assets like Bitcoin and ETH and others, where obviously if the private keys are compromised, you know, that's it. And that's, you know, something we have to think very carefully about. And again, I would see that, you know, depending on the type of digital assets, we'd probably look at different types of custody solutions and taking like a very careful incremental approach.
So you're going to have different partners depending on which type of sort of thing you're custodying, which type of asset, right? So if we're thinking about
potentially
Bitcoin,
that's right.
So Frank, may I jump in for a second? On the provider side of things, we do recognize that most of the banks that we are in discussions with, as part of the RFIs, RFPs process, they are looking that from the very first stage, they will have a solution that can be used for the future assets as well. And I think that a solution that will be agnostic to the asset class itself and will be able to support on the cryptographic layer either cryptocurrencies or any other assets that based on blockchain, whether if it's security tokens or NFTs or equities, they all should relying on the same infrastructure. And I couldn't agree more with the friends here that they should clearly start with cryptocurrencies. This is the most popular and scalable assets. They don't need, on the technology side, of course, not on the value. So they will not have to maintain any kind of private blockchain or anything like that, but start with something that's already existing. And once they are ready to use cryptocurrency, it will be super easy for them to move and offer the same services they do, either if it's custody, staking, DeFi, or others for cryptocurrency, same thing for other assets that's based on blockchain.
So how long is it going to take for all of the banks sort of being represented here to be able to work with someone, work with a provider to custody Bitcoin on behalf of their clients? How long does that take?
Depends on the bank and the jurisdiction they're in. Look at you know, some non-US banks already, you know, up and running, like Zodio and Standard Chartered, the Kameno joint venture. So I think we're already there. It's probably, you know, months, not years.
Even for US based banks?
Probably, I would say a bit further out, but I don't think, I would say it's like a year or two, like at most.
So it sounds like, and correct me if I'm wrong, the impediments here are not on the technical side. Although I'm sure there are some things to think through about, you know, how much of my assets do I want to sort of allocate or sort of have siphoned off with MPC or cold storage or hot storage. I'm sure those are things that are being thought about and considered. But it sounds like the big impediment for US banks is the regulatory question.
depends how you're regulated. I would say, obviously last year through the OCC letters, there was significant increase in sort of transparency and guidance. But if you take Goldman, for example, like we're a New York State bank, so we'd also have to work very closely with the NYDFS and other regulators. So it does depend on how you're regulated. But I'd say it's a mix of ensuring you have a fit for purpose operating model, in particular around bearer assets like certain cryptos. If you're looking at stable coins and even like USDC, for example, there's still a central party that we can go to if there are issues with the USDC. We can't do the same with Bitcoin. So I think we're trying to be very careful in terms of how we think about custody. And then, as Lior and others were mentioning, the interplay of MPC, cold storage, hot wallets, and again per use case, because you do need different solutions for different use cases. And I think the Curve acquisition is a great one. For the retail play in PayPal, obviously if you're doing high volume payments intraday, you're more likely to look at an MPC solution. Even though I agree you should complement it with cold storage.
We were talking about MPC a few days ago, Lior.
Yeah.
So let's break down the good, bad, and the ugly. I think it's something that's gotten a lot of hype, especially over the past year. But your sort of thesis, right? And to a degree, you're talking your own book, but there is some interesting elements here to unpack. MPC at a certain point, when you're getting to a certain size of transaction, becomes insecure.
That's right. I think MPC is literally the standard for today, the standard for managing a certain amount of assets. But MPC is not solving the problem, it only mitigates the risk, because hackers, as I explained before, rather than investing some money to compromise one internet-connected computer, what MPC means is that the private key is just split into 2 or 3 different internet-connected computers. So all of what hackers need to do is just compromising these 2 or 3 different computers. Now, it sounds like it's a matter of time, right? And the return of investment for hacker to invest a few millions to potentially steal billions, this is something that they would probably definitely do. So MPC is sufficient for the high-frequency transactions part. As Dean just mentioned before, the usability is super important, and that's why this layer should be in place. But taking that by itself is not enough, and the need to have along with it a cold vault, which is a true cold vault that never receive input from the internet, and this is different than just not going online, or different than being air-gapped, not receiving the input from the internet at any point. This is what makes the change. This is the way that you should hold the majority of the assets. Now, getting back to your question about the regulation and how could it be a barrier. So as much as we see that eventually the regulation is ready, but as banks are conservative, obviously it takes some time, and they just need to make the decision to get into the game. And on the technological layer, we are at GK8 can make it as easy as possible, because we are actually providing end-to-end all of the solution, the cold vault along with the MPC, the API, and the endpoint application. So it's very as short as 2 or 3 days to make the installation and a few more days of training course. And on the technology level, the bank can be ready to start. While obviously, in addition to the technology stack, there are additional concerns that the bank should have in place, right? Such as the insurance, the protection from money laundering, and even auditing for crypto. We are tackling that in a way that we offer, along with our partners at Aon in London, the highest insurance in the market for a self-managed solution of $500 million per bank. Now, it's not a pooled insurance, it's literally could be per branch of the bank globally. And we combine it with a partnership that we have with Ernst & Young for crypto balance attestation, and partnership with Chainalysis for anti-money laundering that's already integrated in the solution. So on the technology layer, it could be as easy as like plug and play in a few days just to start, but it's literally on the management decision of the bank to jump into the game and just start.
Yeah, I would say that goes back to the point on operating model. Like custody is actually somewhat of the commodity layer. And it's really about building that operating model on top of it and making sure you have a proper fit for purpose business. And I think, as Lior points out, ensuring you're doing your KYC, KYT, AML, whether it's through like Chainalysis, Elliptic, TRM Labs, etc. There's a lot more than just custody if you're trying to build a business. And even considerations like insurance, like actually if you're a top tier regulated custodian, let's say you've got 10 plus billion assets under custody, the leading providers probably have 5 to 750 million in insurance. Actually that's not really enough. And so your concept of insurance, so you really have to be extremely confident with the product itself and ensuring that the product is fit for purpose. I think insurance is used as a marketing piece, whereas actually it's probably not an important factor for deciding your custodian.
So what is the most
I think that's important to keep in.
We can start with you, Ben, piggybacking off of Oliver's point. What then is the most important consideration?
So I think that's why Bitcoin is a good, or cryptocurrency is a good starting point. It's the most difficult to handle because all the topics Ollie mentioned, I think those are the topics you really have to look into and are most complicated with a solution of current cryptocurrencies, but gets very easy if you start private networks among banks where they're only KYC participant and you set the rules how to engage there. So I think that's very important to keep in mind, that once you get that bit through the door, the next steps could be much easier. I think one consideration to keep in mind is what differentiates a bank from other providers currently providing you safekeeping of your assets. And I think there's one key difference. The bank has capital, has very strict rules and regulations, and hopefully has a framework, and I think we saw that before also in the presentation, for dealing and thinking about asset safety, resilience, and security throughout their existence. And I think that's the kind of background which makes it a very good match with those new assets, because you need to be very diligent. You have to have a very resilient structure. But, and that's the new thing, you need to be open to work with providers like GK8 to really deliver your solution. So that's a bit of the challenge for the bank to go and have certain key components you do not control, you get from an external vendor. So that's the thing you really have to look at to do your diligence right, because that's the key difference we have to today. Because today I have a CSD, my tech provider connects me to my CSD, I can see where my assets are and so on. If something goes wrong, there's a place I can go and ask for stuff to be returned. So I have a problem with my tech provider and my tech stack, but nothing is gone. Now you have to make a choice, and if something goes wrong, it's gone, right? I mean, we have to be very clear there, and that's the big difference. And that's a new key problem, I think, for banks in that space. I always get the example, but money, you wire money to somebody wrongly, it's gone as well. Well, to be honest, that happens here and there, and usually we always get our money back. So it's very, very rare cases where money is transferred in larger amounts and then isn't returned. So that's a very much lower risk than, just imagine the one example, you send a Bitcoin to the wrong address and it's just gone. You don't know who it is. If it's a typo, it's really gone. And I think that's the issue you have to keep in mind. Besides being hacked, besides all the other issues, I think it's key that you have to trust your technology provider so much more than you do in the current space. While when you go to digital assets, where I always say, well, in Germany you can issue a bearer bond quite soon on a DLT. The DLT can be run among banks, can be probably even a private chain. There you set rules like in the old days where you can have a central counterparty, or you have rules how to get something back. There's a underlying jurisdiction where you can go to a judge and ask for an asset back. So I think that's a very different world. But when you go to the cryptocurrencies, it's different. But that's why it's a good start, because that's the hardest step to take. And if you take that in the beginning, it's easy to ramp that up a bit.
And you really need to trust your technology provider. There's a vetting process that maybe needs to be a little bit more intense. Dean, how do you go about vetting your digital asset technology provider? What do they need to have? Because this is, at the end of the day, all about trust. It's funny,
Yes.
we're thinking
It's all
about
about-
building
It's all
systems
about
around.
trust. This is where I see banks as a custodian. They are going to play a quite substantial role. You mentioned the stack, and I believe that we are going towards a stack which will be, I would say, more, I would say, geared to address those agnostic I would say, approach with between public and private blockchains. If you allow me, so if to go back 3 years, I think 2017, we were talking about enterprise private blockchains, and now you see in 2021 we are more talking about public blockchains, and this is why I think it's quite important to develop stack which can address both protocols, to be agnostic. And the other thing is actually to have a kind of seamless integration with legacy systems. And just one thing to add in, I would like to say that this digital custodians has a much higher operational risk to handle and to address them, because as we know.
Someone dropped a question in the sort of open chat that I found pretty interesting, and I think, Oliver, I think you were getting to answer it. I saw your bubbles popping up, so maybe we can start with you and then go to Ben. But in terms of the sort of dynamic between the custody provider and the bank client, if you will, what does the bank need to own in that relationship? Probably a lot of the non-differentiated aspects of the tech stack. And what does the sort of provider own? What does that commercial relationship look like exactly?
Yeah. So it depends on the type of bank you are and your existing business models. I mean, for us at Goldman, like we're not typically in the business of custody. Folio excluded, which was an acquisition of ours. But from our perspective, we're more likely to partner with regulated custodians and assessing options around sub-custody. I would say if you're like a traditional custodian, like a Boni or a State Street and others, it's kind of self-evident from the public work out there that they've seen this, existential threat, and they're now working to, build digital asset custody businesses. So it kind of depends on your business model. I don't think we need to, to Eric's question, what do we need to own and control? I would say it's really about your existing businesses and playing to your strengths.
Do you think that some of these crypto native custodians are an existential threat to the State Streets of the world?
Personally, now with the Boni and the Fireblocks use case, I think probably not. And I think they're starting to react. And I would see the traditional custodians looking to either partner or possibly even acquire custodians down the line and then incorporate it into their existing business models. And I think to Dean's point, there's that's a non-trivial exercise, because you've got to do a lot of integration work and actually rewire both the existing custody business and then this new way of doing custody. There's like a fundamentally different way of doing custody, especially for public blockchains that operate around the clock on a permissionless basis.
You mentioned that most banks aren't interested in sort of making custody their business per se. It's probably just that first layer of doing many different things. I'm curious, Lior, since you're engaging with all these banks, you want them to use your services, what are some of the businesses that they're looking to launch? What will be at the top of that list? Are they trying to offer staking to their clients because the yields are so low right now? Do they simply just want to facilitate the trading of Bitcoin, or do they want to get involved with maybe prime brokerage services? What exactly is that, the business that these banks are building out?
Right. So the banks are clearly looking to start with crypto custody, as you just mentioned, but they clearly see that as the first stage. I think one day have the infrastructure, and one day have the very basic ability to let their client just open a wallet and store their assets. Then they can build the rest of the services on top of it. Now, the most popular services that we see are the DeFi and the staking. And on top of that, all of what is related to tokenization, either if it's NFTs that becoming super popular recently, or just tokenization of traditional assets. So the ability to have a support in staking and DeFi is something that is pretty straightforward on top of solutions like GKA solution is work. Eventually, once you have the ability to control the private key, you can have the ability to participate in the consensus algorithm of the staking, for example, over Ethereum 2.0, or when you have the ability to support smart contracts, then NFT or DeFi is just a specific example of things that could be supported over such infrastructure. So getting back to the previous question, once you have the infrastructure that have a general support for cryptocurrencies or for and that it's agnostic to the asset itself or the functionality itself, then you can easily adopt this kind of new services. And obviously, when you want to offer them for traditional assets compared to cryptocurrencies, it's completely other world, right? Because when you want to do, let's remain with the custody for a second, of traditional assets, you just need a bunker and maybe an army around it. But as Ben just mentioned before, once somebody takes control on the private key when it comes to cryptocurrencies, it's immutable protocol, so there is no way back. And obviously in blockchain, it's very easy for hackers to lose their tracks. And that's why a different approach is needed in order to be able to provide also this kind of more advanced services while having the full end-to-end solution that is managed by the bank.
I think one thing we always have to mention is you don't have to offer custody, but to actually be able to play a role in any way to sell an asset or do anything with it, you need to be able to hold that asset. So in the end, even if you don't offer custody to your clients, you need to be able to custody, for example, cryptocurrencies. If you want to build anything on top of it, you need to be able to hold them. And the question, it's a regulatory question. Are you allowed to outsource or sub-custody crypto? And for example, in Germany, the answer right now is no. If you want to offer it, you have to offer the solution yourself. You're fully liable. It's only you. You cannot go to a third party. But that's also an opportunity for banks because people are used to trust a bank and store value with the bank. Digital assets is the opportunity to do that in a new field, to first enhance our processes in current assets. But what are the new assets coming up? I mean, I always have these discussions. You look at NFTs, you look at the a few years younger, let's say it like that, so I don't have to reveal my age, but kids a few years younger, they have a sword out of a game, which is worth 2,000-3,000 euros. It's a lot of money to them. They also already have bank accounts and they understand to store value. So I think there's a lot more for somebody who in a digital asset space who has the technology and the tech stack to safe keep value and store value per person. It's huge opportunity. It's much bigger than what we think about currently. And I think that's very important to keep in mind. So the risk for banks, I think, of course, is always that there's somebody smarter, newer, but because of regulations, those crypto custodians will become somehow a bank, right? So that's like with new brokers, with new banks. But for banks, the possibility is to store value in the new world. The furniture in your virtual room you will have with your where you sit in with your new Apple virtual reality set if you want to store it somewhere, it's very valuable. It's a Charles Eames chair. You want to store that maybe with your bank if they have the tech stack to be able to. And I think that's one of the aspects that are very important. Digital assets offers bank new venues to interact with the client and store value. You need to be able to handle the assets yourself. I think that's very important, because otherwise you move into the derivatives world. So you can give a client exposure, but many clients want a real asset. And the third thing I think we haven't mentioned, what's very important, digital assets offer the opportunities for everybody in the ecosystem. So we haven't talked about CSDs, about banks, about all these neo brokers. Anybody in the system will be able to move in one or the other direction. So a bank can suddenly be the central safekeeping point. They don't need a CSD anymore. A CSD, so the traditional core store of value in the system, could directly access clients. So the lines get blurred, and I think the real race is who will find which spot in the chain and is able to move up or downstream, because in the end, and that's one of the advantages I always think banks have, it's about, you have a client, the client wants something, he trusts you or he doesn't trust you, he wants to buy something from you or doesn't buy from you. If you offer good service, people will stick with you. And I think that's very important to keep in mind also here. So moving up and down the chain, that's an industry discussion. You need the client, but you need to be able to handle the asset yourself to really do something with it. Very important aspect to keep in mind.
At the end of the day, we're talking about organizations that are in the business of preserving, raising capital, protecting capital. And what you're describing is you can sort of expand that business to cover many different types of new assets, from NFTs to one touch the DeFi world. Do you see it as such?
Absolutely. So this is the chance for actually for banks to create a new business models actually, and I think tokenization will support the creation of new business models for sure, and give a chance to institutions like banks or custodians to reconfigure their business models for the future economy.
Yeah, absolutely. Maybe you guys will be all trading digital swords back and forth from one another one day. We shall see. Well, gentlemen, thank you so much for taking the time. I think this was a great conversation, and we'll have to have you guys all back very soon. Take it easy. Ladies and gentlemen, thank you so much.
Thank you.
Thank you so much.
Thank you, Frank.